What is going on, guys and girls? It's the Short Bear, and this is the first video out of a video series that is going to teach you my approach to trading. As you know, I'm a short bias trader. I want to short stocks. My main pattern I'm looking for every single day is the all-day fader. It's going to be a stock that is gapping up a lot and that opens and basically fades down the whole day. Thus the name all-day fader. Now this will be an introduction video, meaning I'm going to go over the main points that I'm looking for in an all-day fader and not go in depth about them. I'm going to make specific videos, individual videos about every single point that I'm going to be talking today. So this should be a nice introduction for you to understand what's coming in the next weeks, months, and years for you to learn. Now the first thing I want to see when I short a stock is basically a demand and supply imbalance. All right. So if you see basically a chart that is trending down for years, this can be through reverse stock splits or just because the company is bad, you're gonna have longs that are back. Basically people that long the stock some time ago and want out. Now every single time the stock is gonna gap up, some of those longs are going to be looking to bail on their position. That creates an imbalance between longs and shorts, and thus the supply will be bigger than the demand. That's why I look at the daily chart on every single ticker that I trade. Now, what makes a stock move? What I want to see is basically, as I said, an imbalance. When the demand and the supplies are met, the stock won't move, all right? But if the demand is bigger than the supply, the stock will move up. More people want to long than people want to sell or short. Now, if the supply is bigger than the demand, the stock will move down. So that's where I have my edge. If the demand is bigger, I'm not going to attack it, or I'm going to attack it with less size. But if the supply is bigger than the demand, and I can see that before the market opens, now that's another thing. Now, how can you find the imbalance before the market even opens? Now, that's where the fundamentals come in. I'm looking for dilution, all right? But what is dilution? Basically, dilution is the issuance of new shares, all right? So when new shares are hitting the market, you need to think about it as basically someone selling a position. Now, if the stock, let's say, trades or has 5 million warrants and they dump it onto the market, you have to think about the longs versus basically people selling. If let's say 1,000 traders want to long a stock, all right, for let's say 1,000 shares, that's going to be 1,000 times 1,000. That's going to be 1 million buying power, let's say, that pushes the stocks up. But if the company dilutes the whole warrants, you're going to have 5 million shares against 1 million shares, all right? 5 million shares pushing the stock down versus 1 million shares that is going to try to push the stock up. Now, which direction is the stock going to head to? To the downside, all right? So that's why we look for dilution. Now, we have kind of 3 main things we're looking for in filings, and that's another topic for another video. But the main things we're going to be looking at are warrants, ATMs, and convertible shares. Those 3 are the most common things you're going to see regarding dilution. Basically shares that can hit the market at not any time, but that if they're there can hit the market at any time. Now, what works against all-day faders? All right. So as we talked about, no dilution. No dilution means basically we don't know if some kind of big seller is going to hit the market, or we're not as sure, all right? Statistics is another video topic, but basically if there is no dilution, I'm not going to be sizing in as big as if there were dilution. Now, volume. Volume is basically demand, all right? Now we've got those 3 points: volume, float, and float rotation, because those 3 are really important to each other. All right. If a stock has a float of, let's say, 100 million, but the stock trades 2 million, it's not going to be as significant as basically a stock trading 20 million shares with a float of 2 million. But why is that? Well, most brokers won't allow you to basically locate shares to short if the float is small. The thing is, if you want to issue shares to short as a broker, you are not likely to allow the shares to be basically naked shorts. Researchers basically naked shorts. Every single short position is built upon some holder that is holding basically his shares, and he allows you to basically short. All right, so to borrow his shares. And if the smaller the float, the smaller basically you can back up those shorts. So the smaller the float, the less selling pressure you're gonna have through short sellers. So if you can basically allow the stock to have, let's say, 200,000 shares to short, but on the other side you're gonna have 10 million volume, you're basically gonna have a potential of basically 10 million buying volume against 200,000 short sellers. And those short sellers are gonna be squeezed out of their position. So that's why we look at float rotation. The bigger the float rotation, so the more often the float is traded, the less power the shorts have, and the more they are gonna get squeezed out of their position. So that's why we look at it. Now, this was the introduction to the all-day faders. In the series, we're going to go over technicals and fundamentals and what exactly I look at when I trade. Those points I just mentioned are just the main points. Now, volume is going to be a huge topic, as well as float rotation, and dilution, as you know, is going to be a huge fundamental topic that we're going to talk about over the next weeks and months. If you have any questions regarding this video, please don't hesitate to answer them in the comments or in chat, and I'll see you in the next one.